How does bias in market index composition affect investors? Imagine you are trying to get a clear picture of the stock market, but some parts of that picture are more emphasized than others. That's what happens when there is bias in market index composition. Market indexes are like snapshots of the overall market, but they don't always include every company equally. Some indexes tend to favor big companies or certain types of stocks. This can influence how your investments perform and how much risk you take on. Many popular indexes, like the Standard & Poor's 500, tend to give more weight to very large companies. These are called mega-cap stocks. They also often lean toward growth stocks, which are companies expected to grow faster than average. Because of this, if you invest in funds that track these indexes, your portfolio might be heavily influenced by a few giant firms. That means if those companies do poorly, your entire investment could suffer more than expected. This is called concentration risk, and it can make your investments less balanced. Biases in index composition also change how much risk and reward you might see. For example, indexes that focus on growth stocks might do very well when the economy is strong. But during a downturn, those same stocks can drop sharply. So, your investment stability depends on what kind of stocks the index favors. If you are aiming for steady growth, you need to understand how these biases can make your investments more or less volatile. Another factor to consider is how index composition affects trading and prices. When indexes add or remove stocks, especially large ones, it can cause their prices to move. This is because index funds buy or sell stocks to match the index. When a stock is added, demand can push its price higher. When it is removed, the price might drop. These movements can sometimes push prices away from what the company's actual value might be, which can impact your buying or selling decisions. It's also important to realize that some index decisions are made by committees, not just algorithms. These choices can influence which stocks are included or excluded. This means that even indexes that are supposed to be passive can have some active judgment involved. For investors, this means it's wise to look beyond just the index name and understand what stocks are actually in the index. Knowing about these biases helps you make smarter choices. You might want to diversify across different indexes or choose funds that try to balance out size and style biases. This way, your portfolio can better match your long-term goals and risk comfort. Instead of relying on just one index, spreading your investments can help reduce the impact of any one bias. In the end, bias in market index composition shapes how your investments grow, how much risk you face, and how easily you can buy or sell. Being aware of these factors helps you build a more resilient plan that aligns with your financial goals.